Check audio, check audio. Hot mic intro. Any questions? Ask us anything. Dispersion, what does it mean? What's the link to my new Substack article? How did I make that great image? Ask us anything. Risk radar, why? Good afternoon, welcome to Chicago Future of Finance. I'm Oliver Rennick. It's Tuesday, it's 2 p.m. We got an hour into the bell. Stocks right now having an okay session, nothing super eventful if you look at just kind of the net move, but there is some important action intraday, and there's a few trades that just keep on working, basically. The main trades that we've been talking about from a volatility perspective have been dispersion, generally long dispersion, a lot of stocks moving around, but the index not moving so much. I've also been talking about long hardware and short various forms of software. Now that started a year ago as the long Bitcoin short MicroStrategy trade. Then it became long stocks, short MicroStrategy, and now it's become basically long semiconductors, short cloud stocks. Or you could still stay short MicroStrategy, which is working just fine as well. Let's go into some charts. Here is the overall look at the S&P 500. Pretty critical line here in the sand at 68. There's one below it at 66. I think you hope you probably don't get there. These are the futures I'm looking at right now, and there's definitely been some intraday action. It's found support at 68, bounced right up. Pretty much what you want to see. I think that's a good situation overall. The other thing that I think is generally good is, again, that semiconductors keep working. Long hard, short soft. That's basically the trade. Long hardware, short software. And the reason why it makes so much sense is because the hardware now is the area of efficiency and productivity. The AI gains that are ripping through every sector, I phrase them as gains, even though they might be losses in the stock prices for a lot of the cloud companies. They're gains for the companies themselves because they're allowing higher efficiencies to show up. A lot of these cloud companies, remember, post-COVID, the correction they went through largely was a force of combining companies, integrations, partnerships, acquisitions, and a lot got left behind that probably should be considered fat. And so we're trimming that fat. Now, one of the things that I've been talking about is the potential for this to get kind of nasty. If you look at index volatility, that's been Brent Kochuba's main point. Go check out the Substack. I wrote details about the AI trade here over the weekend. Oliver Rennick, and by the way, it's free. Number two is that this is the main theme, is that it's happening across every sector right now. If someone's trying to spin this as a populist story about tech displacing the common man, they are missing the point, which is that this is ripping through every sector, and it's happening at a very high level where top-tier coders, Ivy League graduates, people that have built their careers around being the smartest coder in the room no longer are, because the AI is better. It's happening in art, it's happening in finance, it's obviously happening in technology across the software companies, because if you've got a bunch of coders left over from multiple companies, then the AI is generally going to do a better job of coding and accounting. So that's the main trade that has been working. It's short software and long hardware. The other trade that has been working quite well has been to generally stick long dispersion or arguably long volatility. Let's bring in Brent Kochuba, who's joining me from SpotGamma. And I do think that today kind of speaks to a lot of these main themes, Brent, which has been, index pretty calm still. What say you?
Yeah, hey Oliver, on the road here, so apologies for the video. The interesting thing that I think is over the weekend there was these stories that really seemed to pick up on Twitter, right? There was a Michael Batnick chart we were talking about on Friday about the fact that we're having this dispersion in stock movement, but the S&P, right? There was a chart going around about very high put call ratios, and the S&P holding up pretty well despite what seemed like big put call ratios. So the elements of dispersion as being anomalous here is a story that is sort of now it's in the ethos, right? And what I think is interesting that we're hitting this moment where a lot of people are seeing this dislocation, and we're about to hit VIX expiration tomorrow, and then we're going to have Friday OPEX. Now, this options expiration is not a big options expiration. It's kind of an average size monthly expiration, but I think it has the opportunity to sort of free up the index vol. And you may say, hey, Brent, well, VIX is at 20, so how subdued is the index vol? And what I would say is we could easily shift to 25 or 30, and you could maybe make the argument that given the dislocation we're seeing, the dispersion we're seeing, that index vol should equate to a VIX around 25 or 30, right? So I'm again watching this idea that maybe this OPEX does finally release the volatility and some of the things that people expect to be happening, but it has not yet happened, if that makes sense.
Absolutely does, but let's back it up to make sure people can follow along, because this is the key point, no doubt about it, which is that while volatility VIX has been kind of in this uptrend since December, it's been fairly calm at 20. Yes, it's elevated, it's above average, but considering the record levels of single stock activity, which have been quite manic, double-digit swings, that's the dispersion trade. Another way to follow along with it that you have brought to us is looking at the core 1M, which you can see today as another red candle. So an attempt to hit the index early actually kind of failed. And once again, correlations came in from the early high. So we hope that this could continue, right, Brent? Like, we hope that the single stock dispersion cools off without the index level volatility catching up.
Yeah, that's definitely the glass half full, hope here is that, hey, the dispersion calms down, or the single stock vol comes in and the index vol sort of sinks back up, but that results in all stocks kind of drifting up, right? So we resync to the upside. And I think historically you don't see that happening, right? You usually see it the other way, where you get a big drop in markets and the VIX spikes, and that sort of the reversion to mean or the normalization comes through that kind of violent downside. And I think that is what I would anticipate, to be honest with you. And I thought when we broke 6,800 this morning, that was the sign, like, hey, okay, this is the moment where you're really going to see that shift happen, right? That finally we're going to maybe drop 3% in the S&P, and then all of a sudden, bam, you get that big VIX pop, and then suddenly the S&P makes sense in context to how that single stock movement is taking place, right? So,
Correct.
we're still waiting to see
But
that
instead,
moment. And
we
again,
got
I
good
think,
support.
yeah, and I think the S&P, again, VIX expiration tomorrow is that event I'm really closely watching that says like, hey, this is the opportunity for that to take place. Now, the other thing I would note, Oliver, just that I think is super interesting is that last week, we had some anomalous movements again, huge index drops, right? Where you get S&P drop in 1% to 2% intraday, and then all of a sudden, bam, what happens? We mean revert and we close unchanged. Last week we had the highest level of SPX 0 DTE flow on a single day percent basis ever. It was 70.5% of total SPX volume was 0 DTE on Thursday.
Wow.
We've seen these levels hold, so meaning that level of 0 DTE continues to be elevated. So I hate constantly pointing to 0 DTE and saying, is that part of this dispersion trade? Is this part of the reason that we're not giving it up, right, on the volatility side, because we keep getting this 0 DTE stuff? And look, if you're getting record 0 DTE flows again, it's hard to not kind of point the finger at that and say, hey, there's something interesting happening there, right? And you bring up that map there, right? That's all pure negative gamma, right? That red across the map is saying we would expect volatility all over that zone, right? But that volatility keeps happening in the context of mean reversion, meaning we get a 1% drop and then what happens? Then we rip back 2%. So we're just not getting this directional move still, even though we're set up and seen poised for this big trend break, right? And I think that's what we got to watch for, is that trend break that finally sort of manifests itself.
That's very important because it hasn't. And that has kept us intact. I also, Brent, part of me hopes that, maybe it could resolve in the most peaceful way. I know it's glass half full optimistic, but so, just like you can reset valuations by going sideways, there's an analog here, I think, for breadth and the way the market math works. You can, a company can earn money and its stock price not go up, so its PE then comes down over time and it moves sideways. Something maybe similar could happen here, where we clean out this froth and a lot of these single stocks, correct their valuations, but they pop in such a way that it happens all separately, that maybe the index can survive.
That can be a very true statement. I don't want to sit here and say that this has to resolve into the bearish move lower. I think one of the things that is maybe curious is where are the bullish flows moving into right now? Energy is kind of the only place that you look at and say that makes sense. Some of the memory names on the margins, the Mag 7s don't continue to not look that great. Now you want to say, okay, that's the discount and the reason to buy into these things. Okay, that definitely can be a true statement. I think what the problem is here is that you're getting these anomalous, again, volatility readings in single stocks that are the result of these sort of bearish moves down in these major sectors, and it's hard to sort of grasp at what the bullish sort of narrative is at the moment, right? Rates aren't really coming in anymore. The leaders are sort of falling. If you're sort of banking on energy to be the sector that's leading us out of this, the narrative starts to thin a little bit, right? And so I do think that's a little bit of the struggle. The other thing is the market clearly had a very hard time with 7,000. There was a lot of call selling in the S&P at that strike at that level. And so, it was clear that there seemed to be a valuation perspective in the S&P where traders wanted to take a stand at that level. And I say that because we just saw such strong call selling in and around that level. And it was not 0 DT call selling. It was some longer tenors coming in there, right? So that sort of informed me that maybe value was being established or high value was being established at that level.
Brent, it's a very good point that, one, the mags are an ugly chart. You not only do you have the technical breakdown, the lack of support that I was hoping would show up, at $63, but you've also have the RSI down here, which is below 30. I'm laughing, by the way, because chat says this guy sounds Like he's so deep long that he needs a bounce to save his account. I
Who,
guess
me?
they're referring. No, I
Or
think they're
you?
referring to me because I'm trying to find the glass half full here. So number one, I will always anchor my shows in the hopes that stocks as a whole go up because that's where most people are positioned. Yeah, you've got 401ks, you've got the IRAs, you've got the long-term investor. That's the core product. Also, it's America. It's America.
And every dip has been bought in all of history, Oliver.
Yeah, also, too, it's generally the trend. But that being said, Brent, one of the things I'm talking about that is basically a freebie trade in markets right now, where you can hang on to all this, is to be long semiconductors, long hardware, and then short whatever else you think is frothy, whether it's crypto, whether it's software, because there's one chart that just still has not broken, and it's semiconductors. And that really is the kind of bastion here that I think is keeping us together. Do you see those stocks supported by the call flows that maybe were there a couple weeks ago?
Yeah, the call flows in tech, generally speaking, on a whole, are still rather negative on a relative basis. Now, there are obviously certain pockets that are doing worse. I think one of the things here is that, and I will be honest, Oliver, this bleeds in the macro, not my specialty, but it seemed like CapEx was, spending was going to continue at these major companies, right? The Metas of the world and the like. And so, you would think some of these semiconductor type names would do a little bit better, but AMD, for example, that chart's not looking that great. Again, you got to go to the memory names to find stuff that looks kind of bid at the moment, right? And so at the same time where you go, hey, that narrative is the one we should latch onto, I think the software stuff is just way overdone to the downside, right? Anyone who's used OpenClaw as an example for more than a few days, you can clearly see that the demise of like Salesforce, right, is not imminent. So I think that, there's still an uncertainty about the path of how all this moves forward, right? And it is a crowded trade or a crowded idea to say, okay, we all just have to own the hardware names because it's clear that is where, this all sort of resolves and that hardware where it leads over time. Are the valuations realistic, for example? Those are questions I can't necessarily answer. But what I can say is we are not seeing that area of that bullish vector, right? We are not seeing big call buying in the Mag 7s as the names come down. We're not seeing big call buying in, name the tech sector right now, right? It's just a space that at the moment, when I say it's lost its bullish narrative, I mean that there's just not this area where you say, this is where the call buyers are finally showing up. They think Google at 300 is suddenly, a better value, or Amazon or an AMD, or, kind of name the other stocks there, right? And then not only that, when we were talking about SanDisk so much, right, a couple of weeks ago, because the vol was so crazy in that name, and it was up 100 or 200%, right, to start the year, and the vol just got so ridiculous. Those stocks need time to sort of reset, right? That vol got so expensive that it basically was holding those stocks back, right? They couldn't continue the trajectory because the vol just got so expensive. So what does that mean? That means that the traders that come in and play in those sectors, they're not fundamental guys, right? They're not long, short tech guys. They're volatility traders, right? And so the flows controlling those names change, and it's going to take some time when that vol subsides to maybe get normalized flow in there, right? Where the people trading in those names are long, short, value type traders, whatever it may be, not the vol traders. And then maybe the relationships, the price relationships that we expect in these sectors would sort of make more sense.
Okay. It's a very good point. There's going to have to be, there has been a cleaning of froth, right? There
Yes.
has to be. But to your point, there are certain areas where even where I found value in the products now, I start to look at it and go, okay, like, for example, there was that video going around about we did a $200 million budget. Did you see that? Of the the AI movie? It is garbage. It's total garbage. It's like, obviously, like I had no expectations for it to be good, but, things like that where you start to get a little bit overhyped. And I think that it's just in the most simple form is that a lot of these areas were still kind of fat. They had excess. A lot of people were left over. There was overlap in businesses that combined over the last year. Just think about, when you sign in to any one of your 12 subscription accounts, you've got 3 different emails and you've got 3 different security checks. Like a lot of that funnels its way up through some of the same pipes where you've got multiple teams looking at the same stuff, and now you can just run a robot over that. Not terribly unreasonable to see some of that get lopped off. Okay, so then bring it back to the index level for me, Brent. If today we survived a trip below 6,800, how many times can we dip our head under there before we start to take on water?
If you want to say why would tomorrow be different, Oliver, it's because that VIX expiration, I think, opens this window where, we know that OPEX can bring change and can be an area for shifts, right? So if we lose 6,800 and its expiration, then I'm really going to believe strongly in that downside into the 6,600 area. If you want to play glass half full, we hold that 6,800 level and we get OPEX and you say, well, maybe this was the sell-off, to your point, right? Maybe this was the downside transition. It just never manifested in the S&P. But a lot of these single stock sectors that were beat up, now they're set to bounce. That's a viable path. I don't want to argue strongly against that as long as we're above the 6,800 level now, right? I think if you watch that, if we lose 6,800, then I think it's the S&P is going to come and kind of pay the piper, so to speak. But if we hold that level, certainly through Friday's OPEX, then I think we're going to see some of this dips get bought and some of these stuff that, some of these names that seem a little bit beat up. And you say, okay, that was just a mild correction. That's all we needed. So I'm really watching that 6,800 level now. I think that kind of holds the keys. And then lastly, on the same point with the software stuff, those vols were very elevated, right, into last week. So you can say that volatility as an asset or as a source of alpha is certainly strong in some of these names like software stocks. So I still think that you can get away with selling.
Oh.
Sorry, Oliver, not sure if you're still with me there.
No, you can get away with selling. Finish that sentence, Brent. You can still get away with selling index vol.
Vol is an asset class. So, you can get away with selling software options, put SKUs, etc. And even if the S&P has a drawdown, I think that sector and that vol is so high that can still be an interesting trade, right? So you may want to look at software-related put flies and put selling strategies, because how much more is that sector likely to go down, even if the S&P does finally slide, right? It already sort of took its medicine.
Yeah, it's right it's almost at the 1-year low for CLOU, trading at $19, 17.7 would be the low for IGV. A lot of people watch low 76.7. We're at 80 right now, so very, very close.
And just last, Oliver, too, I wouldn't, don't forget about NVIDIA earnings. I think it's coming up on the 25th here.
True.
So we're going to go through this OPEX window. If we had a nice sell-off and then we come into NVIDIA and NVIDIA is just like, look, everything is great in terms of AI spending and CapEx and whatever other story you want from that narrative for bulls, that could be a nice area for everything to sort of reconvene, right, and sync back up. So sure. I think ultimately what you want is some resolution of all these bizarre signals if you're a bull, right? Clean house on this stuff and resync things, and that could create for a much healthier bounce going forward.
So 68 on the S&P 500, last point here, then I'm going to bring in Hans, who's standing by. The strike is 6,800, and the expiry is basically OPEX end of month, right? That's kind of the contract we're watching here.
Tomorrow's VIX expiration, and then Friday's is OPEX, and so this is sort of that turning point, right? Yeah.
Okay.
Wednesday through Friday. This is the window where, again, if we break 6,800 and we lose the structure that's been supporting us, right? The flows have been supporting us, which is what OPEX represents. You combine those two things, and then finally maybe one of these downside moves will actually turn into trend, right? As opposed to sort of just, again, violent mean reversion, and to put it in a term.
Got it. Good stuff. Thank you very much, Brent Kochuba. Nice work.
Thanks, Oliver.
Good setup here. Appreciate it. Great stuff. Mr. Kochuba from SpotGamma, of course. All right, got a little 2-minute break, and we'll be right back. I got Hans Albrecht standing by.
Think of it as the top 10%, let's say.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%? Or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. Let's keep talking about that 6,800 in the S&P 500, which is holding today, but perhaps a bit fragile. Joining me, Hans Albrecht is the CEO at Options with Hans. Hans, what do you think? We've got this debate of viewing the glass half empty or full. I'm kind of hoping maybe there's a half full way where we just churn all this correction horizontally without the index breaking down. What do you think?
I think it's pretty amazing actually so far. So you've probably seen it last week. Somebody put out a chart showing the sort of rolling 7-day or a rolling rate of stocks dropping more than 7%. Massive numbers of those showing that dispersion that you've been talking about. Big dispersion out there, meaning some things are going one way and some things are going the other way. So very much becoming a very binary type market where investors are saying either you're going to figure AI out or you're doomed. And so that's creating some very odd sort of occurrences. And that statistic I just gave you, that usually doesn't happen until the market's down 20, 25, 30%. So that kind of disruption with under the hood is a big thing, right? With that many stocks falling and the market's at near all-time highs, very unusual. So I'm sure you and I sort of feel it. We watch software, we see what's going on. We've seen the sort of knock-on effects into other areas, in terms of legal and accounting, et cetera. So there's a lot of pain in certain parts of the market. And I have to agree with Brent just now. I think at some point, I'm quite impressed. Right now, it's relatively orderly, but I think we're sort of building a little bit of a case for things, the uncertainty starting to sink in a little bit of what this means, right? If we are looking at a market, a few years down the line, which is really the way that you need to look at things. Are we going to have companies disrupted in a very serious way? Are we going to have 100, 150 S&P companies, potentially be in trouble? I don't think that's a huge stretch of the imagination to imagine something like that. And I think the market is starting to absorb some of that, right? And it's the elephant in the room, right? The elephant in the room has been the job question, right? It's been the job question. And I think people have been willing to ignore the elephant to focus on the amazing productivity gains that we're going to get from AI. And no question.
Productivity gains. Last jobs report was fine, though. Did you have an issue with that?
Which one? Sorry?
Last jobs report, 130,000 plus. Not bad. Did you think
it was okay. It was okay. I mean, you back out. If you look under the surface, it wasn't as good as people think, and I think that's why the market kind of reevaluated a little bit.
Not exactly
a lot of healthcare.
Where you want extra work.
Yeah. And I think really in the areas where you don't want to see things kind of trending, which is basically entry level jobs basically disappearing, and I think it's very clear that there's going to be pressure from a company standpoint. If you sort of imagine the average company out there, if you want to compete, you've got to do what everyone else is doing, which is probably adopting these tools, which are really phenomenal. If people haven't tried these things, the Claude bots and OpenAIs, we just saw. And I remember seeing it about a month and a half ago, seeing this adoption rise and the number of skills being created for this thing going, this is parabolic. And sure enough, if you look at, there was something put out by starhistory.com. So it showed the adoption rate for some of these open source tools. So React and Vue and Linux, those names might not mean very much to people, but if you look at the adoption rate for basically OpenClaw, it's literally parabolic. I mean, it blows everything else out of the water. And what that means is there's incredible excitement, and it's a sign of a really horse starting to gallop out of the barn in terms of developers wanting to get excited and create things. This is an incredible moment in the last 6-7 weeks, and I wonder how long the market can kind of handle.
Tell me how to trade it, baby, because I'm using the tools. Does that mean that? So Brent's point was cloud stocks, the volatility to the sell-off at this point looks like a risk-reward in favor of selling downside, collecting premium. What do you think about that?
I think that's fair. I think one of the issues with that and with MAG in general, and I think Microsoft being one of the ones, is that I think we're getting to the point where things are happening so quickly that I think we're even a little bit unsure at this point as to how the hyperscalers are going to fare here, right? This is going to be, I mean, compute costs are basically going to plunge to zero. And so the concept of, everybody being able to, like, I can go out and pick my favorite features of a software program and basically implement that in a couple of days. And I kind of suck at that stuff. A professional could probably do that in less time. I don't have to go out and buy these tools. Now, does that mean a giant company is going to go out and start doing things like that? It doesn't. But if you read between the lines, things are shifting very, very quickly. And so what does that mean for the hyperscalers? What does that mean for Microsoft with an operating system? Yes, they have a very healthy cloud business, but you have to start asking, especially if you can start running these models on local machines that don't even connect to the internet, they don't even connect to the cloud. And I know the average person isn't going to do that. Things are moving quickly, and I think they're going to continue to absorb this worry, because if you think about the news that's come out, we've just blown everyone away in terms of what's just been created with this particular tool.
The Chinese have got the dancing robots too. We got the thinking, they've got the acting.
Yeah, and well, wait till things start to move into the physical aspect. You're talking about robots and automation, and I've seen robots cleaning toilets and bathrooms. And so when you start to wonder, well, who's safe in the end? I think at some point, this is going to be very much a sort of thought.
Well, dancing robots are here, Hans. I'm not sure if you.
Show me those robots.
Yeah, I got them right
here. I saw some in China. That's right. That's the one. Yeah, I saw that one. That's crazy.
Right.
I almost can't believe it isn't CGI, right? I almost can't believe that isn't CGI. But then what that means, what that means, Oliver, is you start to kind of go, well, okay, the way that this plays out is it's probably a lot of kind of white collar jobs that get affected, right? It's one thing when you start sort of destroying jobs for people who rent and don't own assets, and the sort of the lower.
Right? This cuts all the way to the top. This is not really like a lot of people trying to spin this into like this great kind of like populist rallying cry. That's not the case. A lot of these people that are going to be losing their jobs are going to be people who've been making hundreds of thousands of dollars, some millions, arguably in some places. People who have taken on management positions, having come up through the ranks of coding at banks and at Silicon Valley tech companies. This is like, if you ever watched Mike Judge's Silicon Valley, it's like this is the clean house that they never really had for a lot of excess and a lot of fat that is in that place, which should mean that the impact on the economy is manageable, I would hope.
It should. Well, I mean, I think where there's the sort of underlying worry is how quickly it's happening, right? So every technology sort of revolution has come with a bit of a transition point where people kind of have a little bit of time to adjust and find other things. Is this happening so quickly that there really isn't as much time? And so, the possibilities are very wide open now. We know markets don't like too many possibilities and too much uncertainty. And if we're heading for a world where, the top 5 or 10% of very, very AI sort of centric people, the sort of top end AI leaning people do great, maybe make even more money, but then the bottom 50% are competing for fewer jobs. Used to make 200 grand, like you just said.
That's where I differ from you is that I'm going to be able to use AI we should, because of the productivity that you mentioned. The most important part of what you said, I think, is at the top, which is the productivity. That productivity and low cost of tech means that now I don't have limitations to what I might want to do. This is what's happening in art in a big way. Like we were joking about that movie trailer that they said was a $200 million budget they made with AI. It sucked. But guess what? If you actually have a story to tell, and you've got a good story, now you can. tell that story through this beautiful animation that you didn't have access to before. Again, I'm like I've said many times, the automation of being able to do this. I'm one person. This used to have to be an operation that was done by 3 or 4 producers, So I don't think it's dire in the sense it's going to create this big riff. I think that it might actually help in a way. Like, look at manufacturing numbers that are picking up again. Like, that was a dead sector for a long time.
Right. Yeah, absolutely. And so that's where people have shifted. They've said, look, I can't trust an area where there's this kind of disruption anymore. But I'll tell you what I can trust is Pepsi. A bottle of Pepsi is not going to get disrupted, and a bag of cement is not going to get disrupted. And so we're going to move into that, not just for that reason, but for the reasons of older demographic homes, old age homes, if you want to call them that. They've been doing well. So real stuff, real people type stuff that is going to happen, we're going to have a need for no matter what. So I think people really want to kind of dive into things that they can trust from that standpoint, rather than
healthcare looks good. XLV, I got it right now. XLV looks good. XLP looks good. You think those are longs right now?
I think so. I mean, I think they've sort of, I think people are piling into them very aggressively. But if you look at what happened, I think you could make some parallels to sort of the early 2000s. And when the dot-com bubble sort of popped, and I'm not saying AI isn't real and that AI isn't going to continue in a very strong way, the story of AI, but you have it's gotten to the extreme, and we really had many years of value kind of coming back and outperforming, and people kind of going from, .com was a whole bunch of fun, but it's time to move into some real things. And quite frankly, that is where the benefits are supposed to show up, right? For AI to change the world, it can't just be NVIDIA making money. It's got to be everyone else in the world benefiting. And that's probably what we're going to start seeing very, very soon in the numbers, in profit margins. So you're right. It's a two-tiered world right now where there's feast or famine.
Hey, the 2000 reference brings up a pretty fun question, a line of dialogue, Hans. I just pulled up the chart for the internet bubble pop from the quarterly high to low, about a 75% decline. I hope we're not that overvalued. I don't think we are from an index level basis. What do you think?
I don't think so. But I do think that the U.S. probably struggles, because if you think about the tailwinds that the U.S. has had for basically the better part of 2 decades, it's really been digital, and the revenue generated in that area, being leaders in that area. Now, as that area gets a little bit very disrupted, I mean, there's no question. You've got Chinese models that are almost as good. We talked about this last time. They're getting better and better and better. I don't even have to use any of these. I don't have to use Claude. I can get something that's probably 90% as good. And they're going to create efficiencies that allow people to run pretty good models on local machines. It's not happening yet, but small machines, you'll be able to run a local model. We don't need these insane models. And so we've got companies going out and spending $200 billion for what? I'm not sure. And investors are sort of voting with that.
Well, I think, again, that's kind of where we keep coming back to Microsoft as a really interesting case study for all of this, because obviously it was disruptive in the .com. It's disruptive again. But right now, Microsoft is kind of sitting on the fence a little bit, because it has elements of its business that can be disrupted by these things in terms of some of the software as a service businesses. But then it also, and some of the marketing businesses for sure, because a lot of this content we're starting to get is starting to repeat a little bit. That's one of the other things, is like, now that everybody can be a professional meme maker, all of the kind of like content consumption that we're getting is sort of starting to all look the same. So advertising is getting more challenged. That's one place where it's getting challenged. Microsoft obviously has a stake in that. But then at the same time, they also are powering a good bit of this as well, and have obviously a lot of ties into the consumer, which is strong too. So that it feels like when Microsoft is done, that's probably the all clear. Maybe that's my conclusion to this conversation, Hans, is that when Microsoft finally bottoms out, then maybe it's time to start ripping all the dips.
Yeah, I'm thinking maybe between 360, 370 for Microsoft, Oliver. I think that's where maybe they kind of, jettison the, okay. There we go.
Yeah, you know what? In fact, looking at my chart for the 3-year, I got a line at 325. I hope we don't get there. Maybe some support here where we're at, close. Hans, good stuff, like the context, and good thoughts on AI. You've been smart on the tech trade over the last several months here. Appreciate it very much. Hans Albrecht, CEO of Options with Hans. Coming up, Chris Brecher going to look at some levels with me. Maybe Microsoft is a buy here at 396. That would be nice. Be right back. Welcome back to Chicago Future of Finance. We got markets painting a tiny bit, little bit of hurt here. NASDAQ down 0.25%, lost some of the steam that we had there trying to buy the intraday dip. Just taking a quick look here at the chart for the NASDAQ, which has been making lower highs and lower lows. Intraday, 24,677 in change. So not at the lows, but not at the highs. For the S&P 500 futures right now, 68, 56, 50, and VIX at 20.4, still below the highs of the day. Let's hope this doesn't break back down to retest that 6,800 line in the sand. Joining me to talk some charts, talk some dips, maybe find some stuff to buy is Chris Brecher of TradingNest.tv. Chris, how's it going, man? Tell me what you guys are doing on TradingNest.tv.
Talk a lot about secular headwinds or tailwinds. And the way I'm looking at this is it seems like a big secular headwinds now longer term in the software stocks. And the reason, like today's the first day TradingNest.tv. Yeah, thanks for putting that up there.
Yeah, for sure. Gotcha. Nice pick. That out on the golf course. Looks like you shot well that day.
That's my golf court. No, just kidding. Yeah, that's where we went for. That's where we went for.
Score on that day.
No, that was our 30th anniversary out in North Georgia mountains. So that was pretty cool. But what's interesting about the secular headwinds in here and is I did an email today that I worked about 2 hours with ChatGPT, and it looks great. But I used to pay like $1,000 to get an email designed by a marketing firm, 5 years.
Pitch decks. If I'm going to do, somebody contracts me for a video project. Pitch deck. Boom, done. PowerPoint presentations. Done.
Yeah, I mean,
10 minutes. You plug it in. It's incredible.
Right. And so I think there's some big secular headwinds with the software stocks because I'm not sure how much they're needed. Now, does that hurt the
economy? Microsoft yet?
I like what you showed. I mean, I'm into simple is better. And I like those prior tops that you have on the far left. Not right the here? Bottoms, but the tops. Yeah. And it's almost there.
Kind of looks like a little support line, maybe somewhere right around here, 396. Old resistance becomes a new support. You also got a gap.
Yep, and you have three like that, three stalwarts for you: Amazon, Google, and Microsoft. All are hit support. So same thing. I mean, it looks like you just put up the same chart.
Yep.
So there's Amazon hitting this.
Great point. Yep. So we're gonna say a line at $200 probably.
A little lower. So that overshoot. Okay. Yeah, you usually get that little panic. So down at that 197.
Okay. Yeah, I see that. Oversold, by the way. Amazon down here.
Yeah, it sounds corny, but it's definitely oversold. I like that 3 reasons to do a trade because it's still in a downtrend now that the moving averages have started to curl over. But I'd be a lot more comfortable buying it on a follow through to the upside. That and Google. Amazon. Definitely what you were showing with the NASDAQ, it becomes a big deal because the way I'm looking at it is the NASDAQ is getting close to the 200 moving average while the SPX isn't even close. So it seems to me if the NASDAQ goes down enough, the ES will listen. I know it's hard to believe because so many ES stocks are acting amazing. But a lot of times I've seen where the low in the markets are when the leaders finally get hit.
Yeah. So NASDAQ looks like trading below my 50-day simple moving average. Did I do that right?
Yeah, put in
right
the
below it,
200 though, and that's the big
Okay, you wanna
kahuna
go-
now.
All right, sure. Yeah. Go the big boy. That's where you definitely don't want to break down, right?
Yeah, I'm
that's a
more
little further
looking
away.
at it if it kisses the 200, which isn't that far away anymore. Look where the SPX would be. Now, I'm not saying I'm wildly bearish. I'm just using that as sort of my tell, the NDX. But if you put the SPX up there, it's way above the 200.
Yeah. Yes, for sure. Right, there you go.
Yeah, there you go.
65.11 roughly for the 200 DMA.
Yeah, 300 points.
And that 6,600 seems like it's just waiting right there if 6,800 breaks. I feel like that 200-point swing could be quick if we lose our support where we're at right now.
Yeah, and that's, I think, the whole point with why I'm watching the NASDAQ so carefully, that you don't want it to even kiss the 200, because that would probably lead to some weakness in the other. Now, the only thing is, and you're mentioning it just as we spoke, is if the NASDAQ can hold, which means it needs to be led by the big NASDAQ stocks, and if 3 of those that we showed you are hitting support already and they start turning, yeah, that would be great. You avoid disaster then.
Yeah. So Microsoft, if that finds some support, which we're hoping for in the old gap, possibly at $396. Amazon, we hope somewhere around 199, below 200 bucks, if you will. We haven't pulled up Alphabet yet. What looks good or bad to you on that one, Chris? Because this one's still way above its 200 DMA, because it was one of the strongest for a while.
Yeah, it's interesting because I know on the way up everybody loves it, and now they hate it. But it sure looks like if you draw that line about 297, you'll see the prior tops and the prior bottom.
Yeah, a lot of these are very similar in their structure right now, right?
Right, so we actually bought it today. Usually what we'll do is we'll buy an upside butterfly if we're slightly bullish, or let's say we think it hit support, because it probably takes time for it to repair the damage, but the downside's limited. So we did a 295, 305, 315 today for 350 and sold at 390. I mean, we made our 10% and got out of there.
Okay. Well, that's always a nice little trade, right?
Yeah, I mean, we try to do the expensive butterflies because I just think if you do a wide one, it gives you the middle stripe more time to work on your side, and also you don't get chopped up in commission.
Yeah, okay. All right, so I like that approach. Try and keep it simple, right? And generally leaning towards the upside in terms of directionally. Is there, to come back to one of our main themes of the day, as Brent was talking about, if you do like to trade high volatility stuff, you kind of have to go into the IGV or the CLOU or the cloud stuff. Like an Alphabet's not going to be quite as saucy in its volatility as those names, will it? Or I don't know, maybe it's sold off enough to be to have some volatility baked in.
Yeah, the reason we messed with it down at this support, you get some real choppiness like you saw, which I like, that kind of stuff. But I'll tell you, really interesting. We've talked about buybacks before, and we've talked about that buybacks have really propelled the market since 1982. Barron's had a really good article about all this infrastructure spending by tech stocks in AI. They might not have the kind of gunpowder they had before. So they were talking about just the cash flow that a lot of people are like, I thought Microsoft has a big buyback, and you can see
they've been spending it, right? They've been
it doesn't look like
that's kind of the CapEx catch, which
exactly.
Yeah,
and
which is a very interesting point, because for a long time it was the opposite. Basically forever, up until this AI thing, it was always the opposite. I mean, we did stories on that when I was back at Bloomberg 10 years ago about how there was such a strong preference by corporate boards to do buybacks versus CapEx, and the market was rewarding the companies that did the buybacks versus the CapEx. And now, we'll see. CapEx is a little bit of a longer game, and the companies that were doing the most buybacks are now the ones that are investing the most.
I think that's why you've seen Microsoft not go up after earnings. Because most of the time after earnings has a great pop. Same with Apple. I'm surprised it's gone down after earnings. And I have to think that's because of, I'm trying to center myself there. Because I think they're worried. They want to keep their powder dry. And then you have the Microsofts that I think just don't have the money.
Yeah.
The cash flow isn't there at the moment.
It's kind of hard to do both at the same time. You sort of got to choose one a little bit. The recipients of a lot of these burned cash flows and CapEx, NVIDIA and the chip makers still look pretty good to me, Chris. I mean, the chart for semiconductors holding in, little change today as the market turns lower. And then NVIDIA as well had earnings, an up day, held $180, exactly what it needed to do once again.
Yeah, it's funny when you say a stock did what we want and needed it to do,
right.
And that did. They have their earnings coming out, so they're actually in a buyback blackout, but I'm not sure what they're going to say. I'm real interested to see what they say about buybacks.
Yeah, we'll definitely listen carefully. No, it's true, because a lot of these big giants, they're forced to choose now, whereas it used to be easy just to plug it straight into the bottom line in the buyback, basically a dividend. The main point for me, though, that I like is the charts, man. It looks like you got pretty good support on Microsoft. It looks like you got pretty good support on Amazon. Even Alphabet with that triple touch. Nice look on the technicals. Appreciate it, Chris.
Yeah, sure. Thanks again.
.tv.
Bye-bye.
Yeah, nice. All right. We got 11 minutes here into the bell. I got Mr. Scott Bauer joining us to take it into the close as we see if stocks are going to be able to hold on here, as we did get a little bit of a fade that seems to maybe have gotten a tiny bit worse possibly right now with the S&P 500. 18 bips higher off the highs of the day, but off the lows. So I guess we'll call it maybe even right now, kind of a wash perhaps.
It's struggling. Yeah, it's struggling to stay in the green here, which, after where we were this morning, I think is, that's pretty positive, actually. I mean, it was looking, I don't want to say dire, but it was certainly looking like another day where, okay, here we go. Maybe we don't, end down 1% or more, but, we could see another down day here. So, financials coming back to life a little bit here. Certainly software stocks still under some pressure. But, looks like maybe there's some bottom picking going on here.
Good point on the banks. Haven't hit that group yet because they were looking so good at the start of the year making highs. Turned around pretty quickly, but I thought that trade was going to get complicated by bonds, but it hasn't really. Yields came back down, so I think the banks, the regionals always kind of like it when the yields are lower. Maybe some of the big banks like when yields are mixed, but regionals look good, so why not try to close that gap with XLF?
Yeah, certainly looks like it, and there definitely is a gap there. So, if rates are really going to hang in this range, and who knows if they will, but, if the 10-year is just above 4 and fighting to almost have a 3 handle on here, that is good. That's probably pretty good for the region. So we'll see.
XLF and KRE got it up on the chart right now. KRE's in the purple, showing the uptrend. XLF with a couple rough days there. But we were also looking at some of the moving averages on some of these charts, and XLF did fall below it briefly. But you can kind of also see another one of these charts that looks like it's got support kind of bouncing. I'm hopeful that a lot of these charts are showing support, Scott.
You know what? I'm seeing some buying coming in here. Just kind of across a lot of these beaten up areas. So, you don't know when you're ever going to hit the top. You don't know whether you're ever going to hit the bottom. One thing, that kind of stood out to me earlier today, and this kind of coincided with the market at their lows. Not sure if you talked about the VIX at all, but now all of a sudden, out of the woodwork, we started seeing upside buying pretty handily, like the April 80 calls. Calls that are 50, 60, VIX points out of the money right now.
Someone trading looking for disaster.
Yeah, we started seeing some of that come in today, which, when you start to see that, maybe that signals a little bit of a top because, okay, all of a sudden, the panic buyers are coming in, but there's still so much out there, Oliver. And I think PCE at the end of the week is going to be so important to see if it dovetails and follows up on CPI from last week. And, if it does come in hotter, then people are going to look at CPI and say, there we go again. It was just a one-off. We're still fighting this thing.
Yeah. I hope that we get all the numbers that are scheduled.
Hope so.
Because it's a pretty busy week, but then there's like shutdown stuff lingering.
Yeah,
Scott,
we're supposed to.
To your point, though, about the bettors looking at massive out-of-the-money VIX calls, it's actually an interesting thing maybe to pair with buying of some of the dips in your favorite equity
Could
stocks.
be.
Right? Because are those cheap enough to where you could just kind of have it as a cheap hedge where you go, all right, I think a Microsoft or Mags is going to bounce. And if I'm wrong, it's all going to blow up?
You could, but let's just take a look here for a moment at those April 80 calls that I was referring to. Okay, those things are trading right now about 25 cents. 100,000 of those traded today. So if someone really wanted to, buy some stocks or ETFs because they're trying to bottom pick, they don't have to go up all the way to the 80 strike to get some bang for their buck. They could go to like the 45 strike for 70 cents, the 50 strike, in that same range. So, maybe you're right. Maybe that we never know. We never absolutely know what happens there. And we also don't know if that is some big fund, some institutional buyer that maybe is doing that as some major protection against tail risk that they may have on the downside somewhere.
Yeah.
You never really know.
Yeah, no, that's a good point. VIX calls versus S&P puts, two sides of the same coin, or one reason to do one versus the other?
It's funny you asked that because I had an upside VIX position on until last week. It was a March upside call spread position, and I actually rolled out of that to buy downside S&P because to me, the cheaper way, the cheaper opportunity, if you will, from a volatility perspective, was in the SPY. And I know one is really supposed to kind of replicate the other, but it's interesting that you asked that because we absolutely rolled out of that exact position last week.
Okay, right, because it's not always price discrepancies. Certain markets might be, the S&P might be more liquid than VIX at times, perhaps.
Less slippage. I mean,
this is that's a question for them, really.
Exactly.
But I think the idea of maybe taking a YOLO disaster VIX call or S&P put is not a crazy idea because it's a way to play
for sure not
that kind of second order convexity if we do break this key line at 68, because I think we could go to 66 in a day basically if we break this area that's held for 2 months.
Sure, and if that happens, if we see a move that quickly, the likelihood is there's a massive VIX spike.
Exactly.
Now, with the way that the VIX, with the way the VIX skew works, those further out of the money call options will be more affected than kind of at the money or slightly out of the money. That's just how the skew works in the VIX. So, you could be looking at that, but there's never, in my opinion, there's never a time not to have some of that protection. And, to each his own. I probably wouldn't be looking at the 80 strikes when I could, get the 40, 45, something like that for, maybe double the price.
Yeah. I think that's a pretty fun conversation. I think that it's a pure gamble if you're just doing it with nothing else. And it
for
might
sure.
be it might be more of a calculated play if then, you've got an opportunity and, your account elsewhere to load up on a favorite, mags or something like that, a big tank play that you think is going to bounce. Is there anything that you would like to pair it with from the long side? Is there anything that you're really noshing on, that looks good, that looks
the good old nosh? You know what?
Yeah, what looks appetizing, Scott?
Truth be told, definitely got into GLD today.
Okay.
Not really a technical trade, but more, buy the dip kind of trade. So kind of easing my way in there. If GLD falls a bit more to the, 440-ish, 438 area, I definitely want to load up even more there. It's really difficult to know on a day-to-day basis with the sector rotations that are going on. Really, what's going to be the next one to fall? What's going to be the next one to pop? Where are we going to see that rotation? So pretty difficult right now to just choose a particular stock. I'm not really buying it. I'm not really buying into tech yet, though. I'm probably gonna be the Monday morning quarterback a couple weeks from now and say, shoulda, coulda, woulda. But I don't think it's time just yet. I think that there will be time. Not that we may see a bigger sell-off than we've already had, but I think there may still be some time to get into that space.
My tech approach is basically a version of the long tech short micro strategy, long SMH, short cloud.
I want in.
Yeah, they're all variations on a theme, right? The idea being long hardware, long hardware, short software. I call it the long hard, short soft trade. What do you think?
I don't doubt anything you say for after your Microsoft Bitcoin strategy. Trade. No, but you're right. There's so many different ways to approach this market. There's so many different ways to pair things up. And I think that makes perfect sense.
To come back to the gold chart for a second, Scott, I don't really know what to do with this one. Give me a last 30-second thought on gold, because the silver chart seems to me like it is in a state of unwind now and looks dangerous. But I don't think gold necessarily looks like that. Go ahead.
I agree, which is exactly why I went to GLD. I still do believe that gold GLD here is in this buy the dip sort of trade. Now, the line in the sand for me for GLD is that 50-day moving average, which is right around 425. I think there's going to be some real major support if it gets down to 435, 436 area. But boy, that line in the sand really is that 50-day moving average, which you can pull up any chart you want over the last 2 years. That has been the biggest line in the sand of support for gold or GLD.
Okay. You say the 200?
Sorry?
200, Scott?
The 50-day moving average,
50
actually.
Day. Okay.
The 50's at like 425. The 200, boy, if we get all the way down there, that's, you're talking 355 or so. That's a different story.
All right, I see the 50 DMA around 425 in GLD. So
yeah,
there should be some good support down here. I think we got to be wary in silver at this point, though. That's kind of my main message on those.
Yeah, I agree. And, on the way up also, silver was the one that obviously lagged. It took a while.
Yep.
But that's been the bigger one to unwind, the quicker one to unwind.
Went ballistic eventually. Great stuff, Scotty. Nice. Good trades, good ideas on the good thought experiment on the VIX versus S&P hedges. Nice look at the charts on gold and silver. Appreciate you very much, sir.
Thanks. Bye-bye.
Scott Bauer, Prosper Trading Academy. That's it. We out of here. Thanks for tuning in. I'll see you tomorrow at 2 p.m. Central Time. Have a great night.